Alright, so we already talked about a market correction, and now we're going to talk about a market crash, because the natural question is, what is the difference between a correction and a crash? Now, the appropriate answer is simply this. Actually, you can take it in one of two ways. First is a crash follows a bubble, and second is a crash is simply a larger market correction. Now, the latter is pretty easy to figure out. We're going to see a correction of at least 20%. Once the market goes down 20%, loses 20% of its value, that makes it a crash. But a correction just goes down perhaps 7%. All right, so that's the numerical difference. But of course, like most things in the market, there's a fundamental difference as well. And when you're talking about a market crash, what you're talking about is a bubble deflating or bursting. Now, this image we're looking at, excuse me, this image we're looking at is a pretty good representation of what a market crash looks like. Because a market crash doesn't happen unless we are really, really overinflated like we see here. We can't go down 20% logically, or all the way down to like 70% of what we were at before, as in the case of the Japanese market crash, which was the biggest market crash in history. We can't do that unless the prices are really inflated to where 70% a 70% correction actually makes sense. All right. So here is the basic cycle of the market, including or focusing on a market crash. What happens is smart money comes into an industry or even just a stock or a market. Now, institutional investors, they follow up with that smart money. So that smart money could have been venture capital that triggered an IPO. It could have been people who recognize a trend that's coming in the future but not yet here. For example, right now it might be something like VR. The smart money pours in, but the stocks don't really move that much. So that smart money is investment. It's just sitting in those stocks and waiting. Now, the institutional investors are more speculative. They see smart money coming in. They understand that this is an asset that's going to improve in value, and it begins to grow. Now, as it grows, people start to worry. They think, are we putting our money into this too early? Is it something that's not going to happen in the end? For example, is VR not going to take off? In recent memory, there was the green tech or clean tech bubble where people thought if you put a lot of money into solar panel companies and clean energy companies, eventually they'll take off. We saw that not happen. But in many bubbles, you do have a successful business in the end. And before you get there, you've got this question as to whether it's really going to be a successful business or if it's going to be something like the clean tech bubble. So eventually, stocks become looking like they are more expensive than they really should be. The fundamentals don't match the prices, and there's a sell-off. But that's just a correction. As we saw before, correction is just a dip. But the market continues upward. Now, people call that a bear trap. You don't really need to know that. You need to understand this stuff because this stuff can kill you. This stuff will just hurt you. Alright, so let's say that first sell-up happens and virtual reality really does take off. The public gets into it because the media is always talking about it. People get enthusiastic about it, and once those prices are really high, there's a momentum going on. Now, investors get greedy. They put their money in there. They stop looking at the fundamentals, and they just put their money in there because it's growing. We saw this in 2007 with the real estate market. People thought if they didn't put their money in the real estate market now, they would be locked out forever. The prices would be too high, and because prices are always going up, they'd never have that chance. Now, the real estate market in 2008 is actually a very interesting crash because the government fell for it as well, and they enacted the Affordable Housing Act that allowed pretty much anybody to buy a house because they believed that even poor people could get rich by buying houses by taking out loans that they couldn't repay at the moment, but they'd be able to repay later because their houses would be worth so much. Now, that delusion sentiment brings you to such a high price that once you step back and look at the fundamentals, it doesn't make any sense. In the dot-com bubble in 2000, we saw this through the stock of Cisco, which, if you looked at their price to earnings ratio, they the only way to appropriately justify the price of Cisco stock at that time would be to say that Cisco is going to make more money than the entire United States put together. So the trading price of Cisco was equivalent to the GDP of America, and that simply didn't make sense. And eventually people caught onto that and realized they should take their profit and get out. So you got these smart money people selling at this new paradigm position. You got institutional investors selling at that new paradigm position. You got some smart public people selling, and it starts to fall. Now the people holding on are in denial. So what's happening is these people who are holding on, they're keeping the bubble from deflating, and it's not falling as fast as it should. Once it takes a dip, you got this limit where the people who are holding on will hold on, and the people who were getting out already got out, and you've got a little support level there, and it kind of bounces back. Now, a lot of people call this a double top, where you see 1 and 2, and then after that, you got a fall. People today are talking about the U.S. stock market as having a double top. For the most recent, take a look. In the past year, we got this double top. So here's a top. Here's a top. Here's a bounce back, and you could say this is the double top. And from here, it should go downward. That's not necessarily true for today. It might be. It could very well be. I think we are pretty much in a recession. But this doesn't look like a double top to me because we have just 2 corrections. Anyway, you get there, but still the fundamentals don't make sense, even at this price. People get afraid, they start selling, and you get way back down to at least where you were at the beginning, if not even further. Then eventually things come back to normal, as they always do, but that could take a very, very long time. As you'll learn in the next video, after a market crash, we usually have a recession or a bear market, and that return to the mean period could take a very, very long time. In fact, and I'm going to show you an example. Well, let me first state that in my lifetime, since I've been a trader, I've only seen 2 market crashes. Well, since I've been a trader, I've only seen 1 market crash, the 2008 market crash. In my lifetime, there have been several market crashes, and I'm going to just quickly go over a couple of them, but I'm going to dip into the biggest market crash, which is the Japanese market crash, which you'll see here, and I'll explain how that bubble happened. But all of these market crashes are because of bubbles. Where there is a bubble, there's going to be a market crash, inevitably. So let's take a look at the most important couple market crashes in recent times. So I'm going to go back to the dot-com market crash, and we're just going to look at the dot-com market crash and the housing bubble, that market crash, and then we'll look at the biggest market crash, and you'll get an idea of how market crashes occur through these 3 examples. Alright, so we should probably go back a bit further. Let's go back to 1997. Alright, so here you have a bubble of dot-com stocks. All of this is fueled by the NASDAQ, a bunch of dot-com companies like Pets.com, companies that weren't making any profit during this entire time period. They were not profitable, but because people thought they were putting in smart money, whether they're institutional investors or public, it was mainly this media attention of the internet taking off and it's going to be the next new miracle that made people put lots and lots of money, including their entire life savings in many cases, into the dot-com bubble. And here's that double top, right? We got that double top, there's your bear trap, boom, and then you go downward. Now, that deflated eventually because really, you don't want to be buying companies that aren't profitable. And once those companies started going bankrupt, people started to get afraid and they started to sell off. Now, in a market crash, not all of the companies in that industry fail. For example, Amazon, Microsoft, Cisco all did well. They all dipped, but in the end, Amazon's up here, Microsoft's up here, Intel's up here, IBM's up here. They're all okay in the end. But the majority of those low-hanging fruit were picked off by the bears, and those companies went bankrupt. So there's your dot-com bubble. Now, after the dot-com bubble, people didn't know where to put their money. People thought the internet would be the best place, and then after that, they just started to put their money into the housing market. So that bubble started to inflate. Then the US enacted the Affordable Housing Act that allowed pretty much anybody to buy a house. So even more money flew into this bubble. And eventually people couldn't pay back their loans. So there was defaults on debt. And because that debt was bundled into derivatives, that hurt more than just the homeowners. It hurt the entire market. It hurt anyone holding a derivative. It hurt big banks. It hurt people who had money in the big banks. And boom, there you go. There's that bubble deflating, and there's that double top we see. All right. Now, obviously, we're in a new bubble. Now, what is the bubble of today? Most people would say it's a debt bubble. We could talk about that later because we haven't seen the crash yet, and this video is focusing on a crash. So I want to give you an idea of how crashes happen, and then you can make up your own mind whether we are at the top of a bubble or not. The most important crash, I think, for anyone to understand is the Japanese stock market crash, for a couple reasons. It's the biggest crash, and this is a crash that's related to interest rates, which is probably going to be the catalyst of the next market crash. Now, here's what happened. After World War II, Japan went crazy economically. They became the #1 economy in the world, beating America in the 1980s. So even Americans wanted in on this stock market. So everyone was putting their money into the Japanese stock market. Now, Americans were going over to visit Japan and trying to figure out why Japanese companies were beating American companies. And they eventually realized that the fundamentals really weren't there. For example, in pretty much any industry, one Japanese company was worth more than all of the American companies in that industry combined. So let's say, for example, let's say we're talking about a coffee manufacturer in Japan. They make coffee. That's all they do. One company in Japan that makes coffee at this time was worth more than all of the coffee manufacturers in America put together. And that doesn't make sense because all you're doing is roasting beans and putting it into water. So why would that be worth so much more money than the US version, than all of the US versions combined? And once you dig into the balance sheets, you see it's really a bubble. The fundamentals simply aren't there. Now, this bubble is a double bubble. Double bubble, say that. Okay, never mind. So this bubble is technically a double bubble because what happened was these companies wanted more. So even though the stocks inflated by 100%, the companies wanted to get more money out of it. So what did they do? They realized that real estate was also inflating by almost 100%. So they took their money from their companies and they bought real estate. Then after that, they wanted to know the next best thing, and it was a cycle. So they actually used their real estate, they used the value of the real estate to buy stocks. Then they used the value of their stocks to buy real estate, and it's a cycle like that. And eventually it got to the point where, okay, I have all these stocks, I have all this real estate, and people started to realize there was a bubble. And these Japanese investors, instead of buying more stocks and instead of buying more real estate, they decided to use their stocks and real estate in exchange for US stocks. And what that did was it showed that Japanese investors were not so confident in their market anymore. It also created an outflow of money from the Japanese stock market into the American stock market. And you have this, at first, steady decline, but then a crash. And here's one of the most important parts of this crash. It's not over. It hasn't come back yet. We are down like 70% from the top, and it's still going. We're still in a bear market, which we'll learn about in the next video. But after a crash, you can be in a bear market, and generally the larger the bubble, the longer the bear market. So there's your forewarning for this bubble in the US market. Now, interestingly enough, the US had a big crash in 1987, and you see that here. This is actually a ripple effect. It has nothing to do with Japan, really. This is a ripple effect from America. And today, pretty much every stock market is interrelated. So if you have a crash in one market, you're going to see that in the other market. But back in the 1980s, it wasn't such a big idea because America just had a crash in 1987. So let's go back and take a look. Let's go out to 1985. All right, so it looks like a blip in the long term. This little hill right there. So let me actually let's make it not look like a blip. Let's go back to 1990. Why not? All right, 1990. All right. So here's the U.S. stock market crash in 1987. Now, after that stock market crash, the government put some rules on algorithmic trading so that this wouldn't happen again if something bad happened. And actually, it ended up working because we had this Japanese crash in the 90s, and it's not that big in the US. As you can see, that ripple effect wasn't so huge because the people exiting the market were people. They weren't algorithms. So that dip was just a correction in the US, whereas it was a huge crash in Japan. Now, I said interest rates were involved in this crash as well. The Japanese government tried to save the market by raising interest rates, and that just further escalated things. Now, in the US, we haven't raised interest rates for how long? Like 8 years. Until recently, until last September. But we hadn't raised interest rates for 8 years. And now people are talking about, well, the Fed is planning on raising interest rates again. Let's look past 2008. So we got this big bubble that's been growing. And in December, see December right here? Interest rates were raised by 25 basis points. Very tiny interest rate raise. Not like Japan's. Very tiny, but it still caused a correction. Now, if America plans to continue raising interest rates, that could be the catalyst that sends us down into another market crash. So when you're looking at these bubbles, you got to recognize a couple things. First is, why is it a bubble? Where do the fundamentals and the prices of the stocks not match? In the US, it has to do with debt. It has to do with artificial inflation of stock prices via central bank intervention and via corporate intervention, which is essentially companies buying back their own stocks just to push the prices higher, even though the fundamentals aren't there. So it could be that the company's not growing in revenue or in earnings, but the company decides to use its free cash to buy back stocks just to push the stocks up. The fundamentals and the stock prices don't match. And okay, so there's your first issue. But the second issue is, what's going to be the catalyst that brings this bubble down? And that's where you can start predicting market crashes from a fundamental perspective. In my opinion, it's probably going to be interest rate raises. Pretty much everyone knows right now that the stock market is overbought, but because people are banking on central banks, pun intended, putting more money into the stock market, they think it's going to go up forever, or at least until central banks decide not to do that. But if interest rates are raised, well, that could be the catalyst that sends everything downward. So there is your synopsis of a market crash. You basically have a bubble that bursts, and then after the market crash, you have a long bear market, which is what we'll talk about in the next lecture.